opportunistic strategy.
All right, thank you, Ms. Taylor, and hopefully we have Jean still in the presenter room. So Jean Sue, over to you.
Yeah, hi. This is Jean Sue representing Optogenic Strategies. Would you please move the slide to next page, page 30? Yeah. So some highlights of the Optogenic strategies in the past year. We have some success that we were able to implement across various strategies and then deployed as of June 30th, 1 billion commitment. The other side of the success is that the LLER program that I think you all heard from Steve and from Arnie. We invested in the AAA and the AA collateralized loan obligations CLOs. And then they add value to the total fund with a very, very remote probability of capital losses. This is a very significant program for us to earn some extra basis points, basically the alpha to each asset classes in the past. Going forward, we are thinking about pulling this up to the total fund level in terms of the performance attribution. And in the OS and LLER programs, we are ability to negotiate favorable terms due to the current market dynamics. These are also the success happened in the past year. Challenges that we face, private asset classes, the deployment is much, much slower than public markets. So we want to be aware of that. And then on the LLER side, the market volatility can cause some temporary mark-to-market losses. However, our liquidity position on the liquidity dashboard let us see exactly what we have and then what are the sources of funding going forward and then what are the sources of liquidity. This can help us hold the securities to maturity and then earn a liquidity premium. Next slide, please. So here you can see the opportunistic strategies basically have three big components. One is the LLER program that is north of the 10 billion position. And then the opportunistic one, which has the public side, which is public market dislocation. And this pretty much relates to what Margaret was talking about earlier this morning, the PIMCO DISCO 3, that is the public market dislocation. And then we also have the one which is the private debt, and this is the area that we will focus our effort in the next fiscal year. Okay. Currently, if you look at the 1 year performance, the excess basis point is negative 27. This is because as of June 30, the market, although like the investment grade market as well as the equity market has recovered quite a lot. CLO, because of its complexity as well as its illiquidity, it does not recover as fast as other higher liquid assets. We did see a significant recovery after June 30. So we're hoping that next time around when you see the numbers, the 1 year numbers will be positive again. For the 5 year numbers, constantly, very consistently exceed 123 basis points. And then this is the alpha to the asset class, which hold the LLER. So in another way, you can see LLER as an internal mutual fund that always runs, and then the fixed income or the equity as the shareholders of it. Okay. With respect to the opportunistic part, we recently funded 2 opportunistic strategies in June 2020, one in the public market dislocation, the other one in the private debt. Next page, please. Next year, what are we going to focus on is in the, can we move forward to the one more page, please? Okay. Our major initiative for next year is we want to continue deploy money to the private debt to ensure a robust and well-diversified portfolio. And then we also want to enhance our governance framework, portfolio analytics and reporting. As you know, that this is a new area, so we are hoping that we can start from scratch and then build a solid governance process and then build a very robust portfolio analytics, as well as have a centralized place that we can do reporting, and then add like everybody is on the same page. We were able to curate database on that. So this is our focus going forward. So with that, I want to pause here and see if there's any questions on this opportunity strategies.
Ms. Taylor, you're on mute.
Thought I grabbed it. I did not. I do have a question. I'm not seeing. Oh, and I have one more after me. So you had said on page 32, major accomplishments, develops a framework for private debt investment process and due diligence. So I guess what I'm concerned about is making sure that we're not getting into toxic debt of any kind. And so what are those governance processes? Are we looking at, what are our underwriting standards for getting into these kinds of programs?
Okay, so I think this is the question is very interesting because we don't want to get into a toxic debt. How do we define a toxic debt? From an investment professional's perspective, everything has a price tag to it. Okay, a toxic debt, you probably think, okay, this thing is going to go default. But if it can recover 50 cents in a dollar and then you buy it at 20 cents, then you will earn that 30 cents recovery, right? Or if something which is really, really bad and then you get like an option on it you can pay it like 2 cents and buy an option for for whatever the upside is. You evaluate it as the risk reward, the convexity, then it may not be that toxic in a way. So it really depends on what is the risk reward, what is the price. Are we paying a right price for the return expectation, the probability of a success, probability of like a bear scenario? Do we fully evaluate that?
So I guess when I'm looking at toxic debt, I'm looking at reputational risk. Do we want to be involved in loans to sovereign nations and the risk that poses to our reputation? Do we want to be involved in, I don't know. I mean, remember Goldman Sachs at one point had loans to cities and counties, including, I think, Stockton was one of them. And they ended up in bankruptcy. Reputational risk is also what I'm looking at, besides just, what can we gain out of taking on this debt, right? It might be valued at 50% and we buy it at 20 and get the 30%. But do we have like underwriting standards that for collateralization of these loans? Like, what are we looking at?
Okay, I think, so far that we do not plan to do any sovereign debt. So we are focusing on US corporate, European corporate, real estate. So that part is, we do not plan to do the so-called toxic things. And then I think, CalPERS, the OS is also abide by CalPERS' like a restrictive list. So we are not lending to, tobacco companies. We are not lending to Sudan, or we are whatever CalPERS as restriction, we will abide on that. So I think it is important that CalPERS has a robust system of that. And then that is also why that we want to focus our effort next year on, a very robust governance process, make sure that we don't step outside of what the delegation is.
And then you had said earlier that these ER investments in collateralized loan obligations are AAA or AA. I know during the last crash, we found out that AAA and AA weren't actually AAA and AA. Do we know for sure that's what they are?
Okay, this is a very interesting question because the CLOs emerged from the financial crisis on the AAA double level totally unharmed. Even on the lower level, there are only like a handful of defaults. They are very different than the CDOs of the world in the subprime of the world. Very, very different. So what happened last time is that rating agencies downgrading everything with a C and an O indiscriminately. So if you have the conviction and then have the understanding of the fundamental as well as the structure of the product, you are the one who are able to take advantage of it. We did not know much about the CLO back then. We started our CLO investments, majority of our CLO investments way after the financial crisis. But I know that there are like banks, like huge, big US banks. They are buying single A, not the double or triple. They're buying single A at like 20 to 30 cents in the dollar on the CLO single A tranche. And then they all get pulled back in par. So you're earning like 70 points in the next 3 to 5 years when they pull back in par. This is a tremendous return. They're returning like 300 times. So again, I want to emphasize everything has a price tag to it. Understanding the fundamental, understanding the structure, understanding your contract, and then you will be able to take advantage of the market.
So I think we're back to our appetite for risk, is what you're saying.
It depends on how much return that we need to get. When our return target is much lower, we don't have to take that much risk. When our return target is higher, it is a mathematical issue that you just need to do the math, and then we need that higher risk return profile.
Right. Great. Thank you very much, Jean. I really appreciate that. Our next
You're welcome.
person is Mr. Perez.
Hi, Jean. On slide 30, you talked about middle market direct lending and specialty lending. Mm-hmm. Is it different than private debt?
No, these are all type middle markets. The majority of them are private debt. So private debt, as I told you like 2 sessions ago, it's a mirror image of the public debt, right? So you have whatever you have public, and then you will very likely have something similar in the private debt, but they are not SEC registered, regulated, trading in the public market. So the middle market direct lending, you can think about who is in the middle market that I can give you a name. Usually, if you see somebody's EBITDA is right around 100 to 125, they can be pretty big. They can be a company of like the names that you know, but they can also be classified as middle market. The specialty, I think your question is probably in like the middle market direct lending and specialty lending. Are they the same or are they different? Is that your question?
I'm trying to be able to classify it in my brain. So that's all. It's all considered private debt. Yeah,
they are. Or you can all do specialty lending. Sometimes you can do it through public market too. Middle market direct lending, sometimes they do it through migrating into the broadly syndicated market land, and then you can have banks be in the syndicate agent and then sell things out to the market. So I will say it is very hard to have a cut on what is the middle. Is the middle market always private, or is the middle market, sometimes public? But I will say the majority of the middle market lending is private. And then markets, like the financial markets, use middle market direct lending and private debt interchangeably. So this is a little bit, this is why the confusion is that when I say the private debt is the mirror image of public debt, while in the middle market direct lending, sometimes there is a confusion. Yeah, don't forget that the private debt, in real estate, you have private debt too. In consumers, you can have private debt. And in mortgages, you can also have private debt.
Thank you.
You're welcome.
Jason, this is Arnie Phillips. Maybe as an outsider also looking in at this, I think a couple observations I have is one, our timing is very good from the sense that this product is getting off the ground post-COVID and not pre-COVID. So I think our opportunity set is potentially large, but we don't come in with positions already that now have to deal with this dislocation. So I find that to be encouraging. I think having watched Jean, for a long time in fixed income and now in opportunistic strategies, I know even if she's buying a AAA bond, which is a last loss type bond, she's analyzing it as if she were buying the first loss piece. So I personally, and it's only my view, but I feel extremely comfortable in Jean's analysis and her process. And ultimately, we're trying to, for me, the direct lending is really a portion of the market that's not being serviced by the liquid kind of, state-of-the-art bond markets right now that are the types of securities the Federal Reserve is backing. The stuff Jean's going to be looking at are the things that don't have Federal Reserve backing, which has really driven up the price. And so I think we've got a good opportunity, and there's, nobody should be fooled into thinking there's not risk here, because, these are, higher leveraged companies. But we're trying to go into a market that isn't seeing the Federal Reserve support. And I just really think the fact that we don't have a portfolio now and we're coming in post, and as this plays out, and it's possible, the world goes back to being a great place, and it's also possible, we have some more hiccups, and I think, we'll be positioned to do that.
Yeah, man, I wasn't questioning her discernment at all. Not at all. I was just trying to figure out where I can put that little bucket. So in my brain.
Totally agree, and I didn't think you were.
Okay.
It is an area that we think has less players in it, and potentially where the compensation for taking risk is better than taking it in markets where the Federal Reserve is a real dominant player.
Yeah. One thing I want to mention is that the middle market in the United States is 1/3 of U.S.'s economy. Okay, so if you think about, the public markets, that they are so big, and then we know their names, the Microsoft, the fan of the world, they are very, very big, but they are, there's still substantial amount of, this is not the mom and pop shop, but this is your real economy, like the 1/3 of U.S. economy. And if you put it into the world, they are probably like number 7 among the world in terms of the size of it. So this is a significant portion of the U.S. And then by employment count, the middle market itself in the United States hires the most of our employees. It's the biggest employer in the United States as a sector of middle market versus like a big one or the mom and pop shop. So it is an important area that we just need somebody to lend money to them that they can continue to operate and thrive. Does it come with risk? Yes, of course. They're much smaller company versus the big names that we know about in the public market. But it is because of this higher risk that we are able to price it a little bit higher to earn the spread, and then that's how we can try to get a little bit more return. There are times that when everybody is chasing this so that the spread compress to be very, very similar to the investment grade, then we know at that time that we should, stop it or slow our pace, or this is the underwriting standard is being chased to be so loose. We should have some discipline. But just as Arnie said, right now we are very lucky that we are coming into the market right now, that we are like after the crisis, and then we can relook at it, look at what is the current value of the company, what is the projected going forward cash flow of the company, and then size our loan accordingly. At the same time, because this is private, so you have the ability to control what is the document needed, and then what if there's any collateral they pose on it. The document, the contract itself later on will help us a lot in the recovery in case that things goes wrong. So these are all the benefits that we were not in the current like troubled portfolios. We get like a clean slate to go forward. So I'm hoping that this can add incremental values to our return and then get us to the 7% solution.
Great explanation. Thank you.
Thank you. Next question is from Ms. Brown.
Thank you. I want to follow up on Chair Taylor's comments about toxic debt, although I wasn't going to ask about things that had reputational risk. I'm actually just talking about actual risk. And so this is for Jean. We do all our underwriting in-house, is that correct? On this private debt?
The majority of our private debt, we're going to do external. So it's a GPLP format using external manager. Yeah.
Okay. And we pay for that service, correct?
We pay for it. Yes.
Okay. So, I just want to make sure. So with this new private debt, we know or we believe that some loans will default. Some loans will default. But the security is worth a lot more. And we are going to make sure when we make these loans that we have first position or second position, right? That we actually can get the security, because I've done a little this in my past, and I found it difficult to get the security. There's a fight among a number of people and where they are in the rank. And so how would we go about do that? Do we have staff that will do that, or do we also use a consultant when the loan defaults and we want to get basically control of the security so we can decide whether or not we're going to keep that security and manage it as our own asset, or if we're going to sell that asset? I just want to know how that is going to work. And my concern is that this private debt market isn't the same as it was the past 20 years, because the economy is so much different and there is so much unknown. So I'm assuming that some of these loans will default, and that will need to get a hold of that security and either sell it or manage it. And I'm just wondering how that process is going to work for CalPERS. And if that's closed session, you can tell me that's closed session, but I really want to know how that's going to work.
Okay, Margaret, I want to check with you that, are you talking about the one that we do directly internally, which is a very, very small portion of it, or are you talking about the one that we use the GPs to do it?
I think probably right now, because we didn't get that bill passed, it's the ones that we're using GPs to do it. So do they do all that work and they charge us all those fees to do that?
Yes, the GP is in the position, because we are just a participant of the fund, right? So the GP are the one who is doing all the negotiation checks, and in case that the things goes wrong, they are the one who comes into it and to solve it.
Right. But since we were going to do it, and eventually we might do it ourselves in-house, right? How are we going to manage these if we ultimately can do it in-house ourselves?
Okay, so I think our goal was the one that we are going to do internally, it will be almost like, you can think about it as a super senior position if it were a public debt. Okay, what I mean by super senior is, okay, if you have like a manager who's lending to the middle market, let's do it something like simpler. let's say I have a real estate debt manager who is lending to a real estate equity partner, right? So they will lend at, let's say, 70 LTV. Okay. And then they earn LIBOR plus 300 basis points. Okay. But they need financing. Okay. So CalPERS can come in just like any other banks can come in. So we will lend to this manager. So we will lend them at, say, you know, I'm making this up, like, okay, LIBOR plus 100.
Okay.
Okay. So I will be on top of the capital structure. My LTV attachment point will probably be, let's say, 50 or 45 to 50 LTV. Okay, so you can see that in this situation, the manager is equivalent to holding a mezzanine tranche versus I am the super senior tranche. So so we have like three lines of defense. First of it is, okay, we are so high in the capital structure, so we are basically, you know, 0 to 50, right? So we have 50% of the LTV. The probability of the real estate itself falling 50 cents is probably smaller than it falling 20%. Right? So that is our first line of defense.
Okay.
Our second line of defense is, who do I lend to? I'm not lending to the equity partner. I'm lending to this debt manager, right? So the debt manager, they have some assets, they have some other collaterals. Maybe we can do some, you know, arrangement to see what is the collateral underneath it. But it is until the debt manager does not pay me, then I have to take over, which is my third line of defense, the actual collateral, which is the underlying assets.
Right.
It can be an office building, it can be a multifamily residential, and then you will have to take to go in and take care of that. I have two options if it really happens. Number one is using the existing debt manager to do the handling of all the default, and then you know, either liquidate or taking care of the real estate property. Or I can use our strategic partners in our real estate group who are all equity holders of different asset class. And then they will be able to help us to come in and then either, you know, want to like liquidate the collateral, which is the real building, or they can manage it to make it better. So as we were developing this, we are working closely with our real estate department as well as the outside partners. So for every single securities that we go through, we actually had the outside strategic partners help us look into that and then tell us that, you know, how you know, what is the comfort level that they are, given that I am coming in at 50 cents in the dollar, 50% LTV for this specific building in this city, in this sub-sector of the city, in this asset collateral. What is the projected, you know, population growth, everything. So we did, I think we overdid the analysis. So hopefully this type of very defensive play will help us mitigate our possible losses in the future.
All right, and that's what I consider to be the bigger risk, that we end up with the asset, or we end up fighting for the asset, and then do we have a plan for that? And as long as your analysis is looking at that third level, that sort of that stopgap, and we still are going to you know, not lose. I don't want to lose our investment. I mean, talk about not make the 7 or 10 or 8% we think we're going to make, but that we don't lose the initial capital we invested. That's the risk I'm concerned about. All right, so I appreciate the detail, and it's probably more than I should know as a board member, but I'm really worried about this increased risk. Thank you, Ms. Taylor.
Sure, and Ms. Brown, I just want to also ask Jean sort of to comment on this, but I would think if we were doing the private loaning ourselves, we would have a better position than having it through another company. Is that correct?
You know, it really depends. Okay, doing private loans ourselves, I don't think we have staff equipped with the skill set to do that in a more complicated situation, especially when you are taking the real what I consider like lower quality or more complexity deals. What we can do, as I just told Margaret, is that we can do that the super senior position so that you insulate yourself further and further away from the underlying risk. So those are the things that we can do internally. But however, those things that you earn much less, right? So in my example I gave you, you're learning like a level plus 100 versus the one that we're doing in the private debt right now. We're trying to achieve about 7%. So this is a very, very different caliber, very different risk taking, and then it requires different skill set. This is why that we need to use the outside management. Another thing which is super important is for a lot of the higher return strategies, sourcing of the deal is essential. CalPERS historically does not have experience in this. So the ability to get access to a deal, that will increase your deal count, and then you can then filter it and then pick up the one that you think is real, the risk reward wise is more adequate. That is very, very important. And then that is something that the CalPERS internally has less capacity to do that.
Okay, so I'm going to leave that there for right now, but it sounds like I'm going to have some questions on that later. Our next question, sorry, is Mr. Jones. Oh, I'm sorry, Ms. Middleton. My bad, sorry.
That's all right. Thank you, Madam Chair. Jean, thank you for a really authoritative report. I appreciate it. If I understood correctly, one of the numbers you were talking about is you added $1 billion in opportunistic investments during the second quarter of this year. Is that accurate?
It's a $1 billion of commitment. The deployment is 79, as you can see on the next page.
So that's new commitments that were added during.
Yes, and then all this, like the GPLP format, it's a fund that usually have anywhere from 3 years to 5 years term, and then their deployment period is roughly 3 years according to the projection. So you can see them usually for a 1 billion commitment, you need to have 3 years in order to reach the full capacity.
Okay. And is $1 billion a quarter in new commitments a pace that you are comfortable with, or is that somewhat faster or slower than you would like to see us taking on? And I know that depends in part on what opportunities present themselves, but there are capacity issues in terms of our ability to make good judgments on what are the right risks to take on.
Yeah, I think your observation is totally correct. What I think is because of the COVID pandemic, our pace of able to commit is actually faster. Why? Because everybody is seeing that there's opportunity, so they open their fund to do fundraising. So CalPERS is in a very different situation versus 20 years ago when I first joined. 20 years ago that, when I buy, things in the market, I move the market, right? That's also in the public market. It is no longer true that we have to see, people doesn't really want our money. You have to see who is fundraising so that you can see, hey, if there is opportunity that we can participate in it. Some of the funds, especially those very good performance funds, they only open to their existing shareholders or the existing LPs. So you will have to, use a little bit of CalPERS. Okay, we say that we are going to be a very, a good partner, strategic partner, consistent partner, so that they are willing to give us a chance to deploy. So now comes back to your comments. Yes, in the dislocation situation, the deployment is faster. I think today, later on in the closed session, we will talk a little bit more about that. But on the middle market, as I said earlier, assuming that in the United States middle market, 1/3 of the economy is not going to perish. Okay, assuming that we still have that, I see that area is a place where we can have steady deployment. And then again, as I told Mr. Perez, when too many people chasing it, we should slow down. When there are not many people able to do it, we should accelerate. I see right now, because of the pandemic, a lot of people are their liquidity constrained. So it gives CalPERS the opportunity. And I really think to the whole team, total fund approach, and then, especially, when Ben was here, that his vision about we have to have the liquidity dashboard. With that liquidity dashboard, with our understanding of our use and source of liquidity, we are then able to have this opportunity to deploy into the private area. Otherwise, I think we will be, not be able to take advantage of this.
All right. Remind me again, and thank you for that very good answer. What is the total amount that we have an opportunistic strategy right now, and how much more do you want to place an opportunistic?
Okay, so the opportunistic strategy is basically, if you want to see the two big buckets, one is that the LLER we manage, that is north of like a 10 billion portfolio. And then on the opportunistic itself, I think the board last time approved a 5% cap on it. So the 5%, let's assume that our fund is 400 billion, then a 5% will give us about roughly 20 billion. So that is the cap. It doesn't mean that we have to go there. It really depends on the board's guidance on, how much do you want us to deploy on that one, and then we will then follow your direction.
All right, thank you. And knowing being reminded of those numbers and seeing that you're moving at approximately $1 billion in this past quarter, that's very reassuring in terms of the pace of what our investment is. So thank you.
Thank you.
Thank you, Ms. Middleton. Our next question comes from Mr. Jones.
Thank you, Madam Chair. Yeah, my question ultimately is that if we believe that this strategy will help us hit our return target of 7%, if we believe that the necessary steps are being taken to oversee this strategy to acquire those returns, I think that we need to move on it, because I think too often over the years we've talked about strategies and we continue to talk about them, and we look back 2-3 years later, everyone else have jumped on board and implemented it, and we sometimes are still deciding what to do. And that goes to Jean's point about it. By that time, it's saturated. And so it doesn't make sense to get into it. So my question to you, Jean, and maybe this is for Dan also, is do you have the resources to really execute what you believe needs to be executed? And so if not, then what would it take to provide the resources so that we're not going in this into this new paradigm, underfunding your resources that you need to execute? So if we're going to go, and as you said, the board has already adopted a policy of up to 5%, but then, sometimes you have to move faster than slower in order to get the benefits from the new strategy. So what are the resources that would be needed to execute in a timely manner on a pacing that you believe would be the appropriate pacing to implement this strategy?
Mr. Jones, maybe I'll jump in there. And thank you for the question. We appreciate the support around resources. This is a conversation Jean and I have had probably maybe a dozen times over the course of the past 6 or 8 months. And we're trying to strike that exact balance. I do think that we have the resources that we need in place right now. We do want to be deliberate in building the team and in building the capability. To Ms. Middleton's questions, we want to be also very deliberate in our pacing and our committing of capital. If we get to a place where we think we have a constraint, certainly we'll come back to you. But I would say that one of the first things that we needed was just that ability to go to 5% of the total fund from a policy language standpoint, just so that we didn't have any sort of self-imposed constraints. Now, as we continue to deploy, we'll be looking at whether we can deploy in size, whether we need resources, whether we should have this be an actual allocation in the upcoming asset allocation process. And in this sort of exploratory phase, I do think we have what we need, and we'll continue to monitor, and certainly we'll come back to the committee as we need more.
Okay. Thank you.
Right. I think our next person is Ms. Oliveira.
Thank you, Ms. Taylor. This question is for Ms. Sue. I wanted to get some clarity on what you said the middle market range is.
You mean the range of the, we usually use the EBITDA size, so anywhere from 25 to 125. We're targeting right around 70 to 100. So you have a range,
Okay.
a different.
That's our range. Okay, got it.
It's a big range. Mm-hmm.
No, I know, and it can go down as low as 10. So I just wanted to be clear where we are within that range. I think it might be helpful for the board to see a quarterly report on middle market performance and what's happening. There are many available out. It's not something the team would have to put together, but it could show the flow of how these funds work. Also, a chart of the capital structure, and so what senior secured means. This is relatively complex. And so, I'm happy to send a link with this report, but I think it's better if it comes from the team, because I think it's easier to understand when there's a visual representation of this information and when it's compared to other asset types.
Okay, thank you, Stacy. We can look into that.
Yeah, I'll send a link to team.
I think our next person is Mr. Miller.
Yeah, I think most of my questions have actually been answered. So I just do want to say thank you for the very, very comprehensive presentations, Ms. Sue and the entire team. And I'm very encouraged that we continue to make the progress, that we're continuing to stay the course, and whatever we can do to continue to support the team. I know it's turbulent times, but it's also times of opportunity, and we need to really, keep our focus. And I'm glad that the investment office and the entire CalPERS team is doing that. And so, as Ben used to say, stay calm and carry on. And I'm really looking forward to, the next few months should be really eventful. Thank you.
Thank you, Jean, for your presentation. Again, it was a very good presentation. It looks like all our comments are done, and I hate to do this, unfortunately, or we're not going to have lunch if I don't. We've got 2 more sessions. We've got real assets and private equity, and these are taking a little longer than I thought. So I want to call for a break for lunch from 1 to 1:45. That's okay with everybody, and we'll meet everybody back here at 1:45.
Sounds great. Thank you, Ms. Taylor. We'll see you at 1:45, and we'll have Greg all queued up to go on private equity. Thank you.
Sounds good, Dan. Thank you.